So I just finished reading Investing for Growth by Terry Smith, who is a very successful fund manager from merry old England. And in that book, he said something about cheap stocks that really knocked my socks off. So I'm really excited to show you what that is, as well as some actual cheap stocks. Well, howdy there, partner. My name is Russ, and I am a welder who is passionate about passive income. And I also have a free and fantabulous weekly newsletter where I share with you, yes, you, an investing thought, my portfolio moves, and some stocks about to go ex-dividend. The link to that and a few other sweet affiliate offers are in the description below. And this video is brought to you by The Stuff and its irresistible taste that makes you hungry for more. The Stuff, where enough is never enough. Benjamin Graham, the father of value investing, taught Warren Buffett something, who taught me something. Really important is that when you buy a stock, you're buying a piece of a business, but you could take it a step further and you should think about it as if you're buying the entire business. This connects perfectly with something Terry Smith wrote that hit me like a ton of bricks when he said, quote, "I have been asked whether a share is cheap many more times than I have been asked whether the company is a good business." And I'm like, duh, I did that in the beginning too. And sometimes now, where I was focused on finding deals or cheap stocks instead of finding those good quality businesses. So if you're just starting out, here are 3 simple ideas that Terry Smith shared that actually work. First is to buy businesses that already won the race and businesses that last, which means looking for companies that survive tough times like many of the ones in Smith's portfolio that have been around for over a century. They're not the hot startup, they're proven businesses making products and or services that people actually want and need year after year. 2, only invest in what you understand. Warren and Charlie referred to this as their circle of competence, and basically, if you can't explain how a company makes money to your grandma or a kid in kindergarten, don't put your hard-earned cash in it. Keep it simple and stick with what makes sense to you. And 3, quality beats cheap every time. A great business at a fair price is way better than a mediocre business at a discount. And most investors seem to get this backward. One of the things that I've learned from investors like Pulak Prasad and Terry Smith about what makes a quality business is something called return on capital employed. So let's try and make this super simple and think about borrowing money. If you borrowed $100 at 10% interest, but only made $5 using that money, you'd lose $5 every year. But on that $100 you borrowed at 10%, if you made $20, you'd gain $10 every year, which would be a 5% return, making you poorer, versus a 20% return, which is building wealth. And that's exactly how businesses work. The good ones generate more money than they use, which is called ROCE, or return on capital employed. And one of the places you can do this, here we are at finchat.io, which you can check this out for free, all the way at the bottom left-hand corner. And this is for Visa, ticker V. They have a 5-year return on capital employed of 30.1%, which means for every $100 of capital that Visa employs, which is all the money available to them through debt and equity, they earn $30.10 on average over 5 years of EBIT, which is earnings before they pay interest and taxes. And Pulak Prasad likes to see a 5-year ROCE of over 20%, but I think we can lower the bar just a little bit, and 15% and above is still a really quality business. And the reason that we want to look at a 5-year or 10-year return on capital employed is because it's kind of like cheating. We're already betting on a team after they've won the championship. And we know then that it has a real money-making advantage, and it's not just a one-off fluke or a 1-year manipulation to get that number up. You can go to 13f.info, and this will show us what most of the big funds are currently holding and some moves that they've recently made. Now, this information can be a little bit stale, and don't ever buy just because you see one of these funds holding something. But if you search for Fundsmith, you'll see the top one, Terry Smith. There he is. And that will bring you to all of their 13F filings. Now it's pretty cool because if you click on Q4 24, which is the most recent, you'll see that there's 38 total holdings, and that's as of December 31st, 2024. Now this is April 3rd on this recording, so again, they could have blown out of some of these positions. This is just for idea generation only. And we're currently sorted by the percentage of the portfolio, which their top holding is Meta Platforms. Then you can go down the list: Microsoft, Stryker, ADP. Terry Smith thinks that these are quality businesses that have a moat or some sort of advantage. So you can use these to get ideas and see what they're holding. And one other interesting thing is we see this box compare Q4 24 to pick your poison. We'll go Q3 2024, which was last quarter, so you can see what they've done over a quarter. Or you can go back further and pick Q4 2023 to see what they did over the course of a year, so on and so forth. And if we sort by change percent, you'll see the new positions, which they added MedPace Holdings, ticker MEDP, and Doximity Inc., ticker DOCS. And even though there's a zero there, you can see the difference. They sold 2,844 shares of Stryker, so they did a whole lot of selling, and they exited 4 positions completely, which was Apple, McCormick and Company, ticker MKC, Cognex, ticker CGNX, and McDonald's. Now, I don't know exactly why they sold out of those. I'm sure they have their reasons, but hey, it'll give you a little flavor of seeing that they sold 924,000 shares of Visa, as well as many other companies. But here's the cool thing. We're going to find out if some of these are undervalued. Because here over at simplysafedividends.com, which you can try out free for 2 weeks with just your email address. That's it. I imported all of Fundsmith's current holdings from that 13f.info page, and I made this on April 1st, 2025, so this is to keep track of some of them, and that's what the gain or loss would be there. It's just over a few days, but I wanted to keep track and see, because Simply Safe has their own valuation metric. Not a fact, it's just a third party's opinion, but the most overvalued position that Fundsmith has is Philip Morris. Now, you might want to pause the video. I'm going to scroll a little bit slow as we wade through into the reasonably valued stocks, which Rollins they have. Damn thing never wants to go down. I know it's Mr. Williams's white whale. They also have MasterCard, Procter & Gamble, so he likes a lot of these companies with moats. There you go, Nike. Big old dump. They got hammered from the tariffs. What's going to happen? I don't know. There's 2 kinds of people. Those that don't know they can't predict the future, and those that know that they can't predict the future. I like to fall into the latter camp. And here we are arriving at the potentially undervalued companies. For brevity's sake, we'll go through them quick. Meta Platforms, ticker META, just a smidge undervalued. Graco, ticker GGG. Microsoft, ticker MSFT. Marriott, ticker MAR. And you can see a lot of his companies actually do pay a dividend. Texas Instruments, ticker TXN. Zoetis has been on my watch list too. They do pharmaceuticals for your pets. It's like pet meds. Ticker ZTS. MSCI, ticker MSCI. Good old PepsiCo. Got Google looking pretty undervalued here, according to Simply Safe Dividends. IDEX Corporation, ticker IEX, looking mightily undervalued. And then the last 2 that Simply Safe has a valuation rating on is Exponent, ticker EXPO, and obviously, a lot of headwinds here with Brown-Forman. I believe they make Jack Daniels. They are a liquor company. Ticker BF.B, looking way undervalued. Now, that is not financial advice. You still need to do your homework, but I'm reminded of something that Terry Smith loved sharing from Charlie Munger, was that if a company earns 6% return on capital employed over 20 years, it's going to be really hard to do better than 6% returns, but if they're bringing in an average of 18% return on capital employed, you are going to have a fine result, even if you pay a little bit of an overvalued price right now. That's not opinion, that is math. Quality businesses create wealth over time, whether you got a smoking deal on them or they were a little bit expensive when you bought them. Well, I hope you like this, but in this floating little box next to my head, I know you're gonna like the conversation I had with a government auditor named Dan Weston. And this government auditor shared some stocks that he thinks are going to do well. So click that floating little box next to my head, and when you do that, we will talk to you there.